you want to get started in investing in stocks. You want to get started investing in ETFs. Both are good. Both are great. The most important part is that you start investing ASAP. The younger you are, the better it is in the long term, the more time your money has to compound. So if you're young right now and you see this video, start investing. Please, it is good for you in the long run. And what we teach here is we like to be investors. And I don't even know why I have to say this, but when you're an investor, you invest for the long term. People say short-term investing, people say long-term investing. It should just be investing. And when you say investing, you always mean investing in the long term. So we're investors here, and we like to buy great companies that create great products or services for customers and return cash to shareholders in the form of share buybacks or dividends. So if you're not looking to buy stocks, you can also buy way safer investments that do not have single stock risks, like an ETF or a mutual fund, things like that. I usually like ETFs because they cost less. Because you pay a certain fee for accessing these managed funds. And normal people, I don't think they have a lot of time to research financial statements and research companies' earnings and, kind of determine what company best suits them and what company is the safest in their analysis. So I think the ETFs is a very safe road, and I applaud anybody trying to invest in ETFs. I started in ETFs, but it just got me into wanting to buy single stocks, and I love buying single stocks, and I do invest in ETFs as well and mutual funds, but that's more in my retirement accounts. But primarily buy single stock companies, as you know from watching this channel. So some I suggest, and this is not investment advice, but please do your own due diligence, look into it. So we have 5. You're just investing in these 5 and you'll be good to go. One you can leave out, I'm telling you now, one you can leave out is international, or you can buy international and just put it as a smaller percentage of allocation. It is because international historically just trails the domestic US companies. So you can have it, you can take it or leave it, in my opinion. So the first is SCHG. It is a large cap growth. So you're focusing on companies like Apple, companies like Microsoft, companies like Tesla. So you're focusing on those types of companies. And the second I suggest is VOT. This covers the mid cap growth companies. The third is VBK. This covers the small cap growth area. And the fourth is one of my favorites, the real estate index fund, which is VNQ. This is Vanguard's VNQ. So this has companies that buy real estate and then rent them out to people, and they are companies within our stock market. So companies like Digital Realty Trust. So these people, they buy data centers and they rent it out to large tech companies, and they make their income through that. Companies like American Tower, who operate and rent out cell towers. Crown Castle does the same. Public Storage, Prologis, other companies like that. And lastly, like I mentioned, is the International Growth Fund, which is EFG. So all these tickers, you can go into any broker, type in that ticker, SCHG, and out will pop up the Schwab US Large Cap Growth. And then if you type in the other tickers that I provided, it'll do the same. So that's it. You're ready to start in a very safe way with these ETFs. And through M1 Finance, for example, you can build a pie with these ETFs. And I currently have mine as SCHG gets 25%, VOT gets 25%, VBK gets 25%, and VNQ gets 15%, and EFG gets 10%. So I think the main goal here is to consistently invest into these ETFs and just set it and forget it. Right now is a great time to start. Market's on sale, in my opinion. Everybody do your own research. Do not take advice from someone on YouTube. Have a good one. Bye.